Hello, everybody. This is James Garcia, broker with Capital Real Estate, here with some financial information for you. My friend Todd Pankratz, the general manager of Wallick and Volk here in all Central California, has joined me on this call to give us some great information and some insight as to what's happening in today's finance world. Hey, Todd, thank you for coming on to this with me, man. How you doing?
Great, James. Thanks for having me today.
Awesome. Congratulations, by the way. Todd is the new manager of
Thanks.
Wallick and Volk.
Yep.
And really proud to see that, man. Todd is a longtime expert here, finance expert here in the Imperial Valley. Todd is just one of those guys that everybody knows if Todd's the loan officer, you're in solid hands. So I'm really happy to be on this call with you, Todd.
Thank you. I appreciate that.
Absolutely. I mean that. And then really want to get some good sound advice or hopefully give our clients and friends out there some good, a better understanding as to what's happening with the finance industry. And so what can you tell us, like, what are some of the general changes that have occurred in the finance world since the coronavirus has come into everybody's lives?
Well, there's, from different sides of things, it's brought a ton of volatility to the bond market, which is what drives the interest rate market for various mortgage loan types. So it's kind of caused that to go a little chaotic up and down and all over the board. The dust really hasn't settled on that yet. It's still it's very fluid right now because things are kind of going day by day. This whole virus has been, ramping up basically as time goes on. I don't think we've seen the peak of it quite yet. We're probably a few weeks out. So there's just a lot of apprehension and uncertainty, I think, that it's brought from as far as, from buyers and from sellers and different things like that. And in the loan industry, it hasn't changed loan qualification guidelines or loan program guidelines per se. It's just done a whole bunch of crazy things with, rate markets and different things like that. It's kind of tossed that on its ear for a little bit. But from the transactional side of things, it's actually, we've got social distancing, we've got now, and we've got issues where you got, your movements have to be very careful and calculated. There's new guidance that's just kind of come out for all loan types with regards to appraisals. We have a lot more, there's some sort of semi-emergency measures that have been put into place where in many cases you can, if the situation is correct and the loan to values are right, you can have, for example, a interior only appraisal instead of a full interior and exterior appraisal, so where the appraiser doesn't have to go inside the property.
An exterior appraisal.
Otherwise known as a drive-by sometimes, something like that. So there's a little bit of latitude with that because, you've got some sensitivity now where if it's, you got a home where either people are still occupying and then they may be apprehensive and the appraiser may be apprehensive on getting his job done. So there's a lot more latitude right now at this time with regards to the appraisal process and what can and can't be done. And sometimes we've gotten somewhere, again, if the situation is right, you can have a full-on entire appraisal waiver. So that pretty much it is across the board with agency loans, conventional government loans, except for bond loans so far. The state bond, the CalHAFAs, and the grant loans, those at this point the servicers still require a full on interior and exterior appraisal.
So basically, Todd, those grant loans that you're speaking of, those are overlay. Those are things you add on to a particular loan product, right? So
yeah, so to speak. So when it comes to a grant or a bond, and you may want to call it a first-time buyer loan, or in some of them you don't necessarily need to be a first-time buyer. It's not a magical loan that's specifically for a first-time buyer. What it is it's a loan. Usually it's down payment assistance or closing cost assistance that go along with one of your four primary mortgage loan types, which are conventional, FHA, USDA, and VA, veteran loans. So those are your primary loan types, whether you're a first-time buyer or not.
Okay.
Then within those subsets, if you're a first-time buyer, you need down payment help, you need closing cost help, you can go and we can do a bond loan that helps with that stuff. So that's kind of how that works.
Okay. So let's say that primary vehicle doesn't require necessarily, maybe they're eligible for that more lenient appraisal, but bringing in that additional product, such as the grant, then that overlay now is going to require potentially a full.
That overlay is going to require, yeah, at this time. And again, things are moving relatively quickly, and things change week by week right now as the situation presents itself. And so, this is something that's developed over the last several weeks. They loosened that part of the process up yet at this time. It doesn't apply to the bond loans. The bond servicers, there's a specific set of servicers that service those loans, meaning when you make your loan payments in the end, when you already own the home, there's this very specific servicer that's going to service that bond loan. They're still requiring those full appraisals just on the bonds. Now, that could change next week. I don't know, but up to this point, that's how it is right now.
Okay. So that would be pretty important information is that something you can find out ahead of time? Let's say, for example, we, as a realtor has a client pre-approved with you and we're getting ready to write an offer. Would you be able to know prior to going into underwriting if they're going to require a full appraisal, or would we be able to utilize an exterior appraisal? Would that be something that we could convey to the listing agent?
Yeah, you would. It'll be on the automated underwriting findings. So your preliminary findings, your desktop underwriter or your loan prospector, Fannie Mae, Freddie Mac findings, it'll be on there.
Oh, excellent.
So if you've got a waiver, if you got whatever, it'll be on there. That, and then there's specific loan to value criteria. So if somebody's putting a decent down payment down, their loan to value is lower, then they'll automatically get the exterior only.
Okay.
Yeah.
So speaking about the finance products, as far as conventional financing, USDA financing, FHA financing, VA financing, how are those FICO scores? How have they adjusted? Because those are some of the most common ones, basically, that are utilized today in today's market. And have any other criteria changed with those programs?
So the basic criteria is the program qualifying criteria haven't changed. And a conventional loan you can do with as little as 5% down. Okay. So you don't have to put there is a common theory or it's kind of a misconception that you've got to put 20% down in order to have a conventional loan, but you can do it with 5% down easily. It's just that with 20% down, you will have no mortgage insurance if you do that. But you can get a conventional loan with higher loan to value or with as little as 5% down. That being said, the main impact that's been happening over the last 2 weeks with regards to credit numbers and credit scoring or whatever are all of your government loan types, the FHA, the USDA, and the VA. Mm-hmm. Those have had the credit score minimums increased by most lenders across the board. And so whereas we had a moment there where normally we're doing, say, FHA or VA loans, USDA loans down to a 600 credit score. So suddenly get a notice that, hey, 680s are minimum right now because there's so much volatility in the back end trading of it that there was the government. This is going to get a little bit in depth. The government did some things where they started buying bonds, buying mortgage bonds, and it created a backlash having to do with forward commitments that made it where there was suddenly no appetite for anybody buying a government loan. Basically, there wasn't a make. So, or at least a low or mediocre or low end credit score one, because they felt like those are the first ones that may have problems.
Right.
So there was a very quick and sudden increase in the credit score minimums last week. So the qualifying criteria is all still the same. Okay. And it's funny because you can have somebody with, let's say, a 620 credit score that technically qualifies for the loan, but you might have a hard time finding a lender that'll want to do it at the moment. So that's all it is. And so it just has to do with volatility and how those loans trade.
And how much risk those lenders are really willing to incur.
To take on, right. Because the perceived, I think the perception was that looking forward, between not only new sales and new purchases and new loans being done, but the existing of portfolio of loans that were kind of marginal to begin with,
Right.
as things go forward and as the economy starts to struggle through this whole thing, and as people are off of work, it tends to be the lower end of those high loan to value, lower credit score loans tend to be the first ones to start going to foreclosure and falling by the wayside.
Right.
So that it's considered just like it's a little bit higher risk bucket, if you will. So those are the ones that they were trying to kind of avoid doing right now until all this kind of passes. I think it'll pass. I think that things will settle down going forward. It's just there was a really quick and sudden tightening, basically.
Right. And that's key what you said there, too. Last week, I mean, just one night to the next.
One day to the next.
Somebody who was qualified on Monday, by Friday, they were no longer qualified.
You just couldn't get them pricing for it. They may be still qualified and approved. Just good luck getting the loan locked and done, like that. They were just in a position where they're going to have to wait till that comes back or whatever,
Because to kind of give folks an idea, maybe getting a little deeper in the weeds here, though, because as a lender, a lender is typically always looking to see who their buyer is for that loan, right? And so if they think it's going to be difficult to sell that in the secondary market, it may not be a loan they want to do.
Correct.
Yeah.
Yep. That's a piece of it. Correct.
And where do you see interest rates? I think a week or so ago, they kind of went up again. They were all-time low. You were hearing that all over the place. Interest rates are at an all-time low.
All-time low,
all of a sudden, they went up like a point overnight again.
Yeah.
And then last night before I went to bed, I read somewhere we're low again. Where are things?
They're not. Okay, so what happened was, yes, they were gradually coming kind of down to an all-time low. And then as the whole coronavirus issue started ramping up and growing, again, it created this mass kind of nervousness and volatility, and the interest rates did spike up a tremendous amount in about a 48-hour period, almost over, I'd say, an entire percentage point, which is pretty rare that anything ever moves that far that fast. And so it was crazy. And then took a settlement over the weekend, and then going into that following week after that, it started to come back down a little bit. But the way the bond market looked, the pricing was right, but you weren't seeing it reflected in interest rate pricing. And so what's happening is that kind of like this: if you suddenly have interest rates that go extremely low, part of it is that you can't. There's a twofold thing. Part of it is, if suddenly everybody in the world wanted to buy and refinance at the same time, you physically don't have enough people left on hand to handle that kind of volume. So there's that part of it. And so then what you do is, if they end up just pricing or pushing the interest rates back up, it will slow that down. It'll pretty much pump the brakes on that.
Right.
If you have a massive rate drop overnight and suddenly everybody wants to do something, you don't have the manpower to do it. And this is like nationwide, on a large scale. Right. So they I think there was a resistance against that. They kind of got pushed back up again, theoretically, metaphorically, to pump the brakes on that.
Okay. So some of that wasn't necessarily market driven as far as stock market or bonds market, but lenders themselves was a way to kind of slow it down a little bit. Kind of
a combination of both, because what happens is when you do a rate lock, there's a commitment on it, and to the consumer on our end, it's an actual hard rate lock. Well, on the investor end, it's actually like a promise to buy that loan, and so things can change in that time. And what was happening was, as those low locks were coming in, there were starting to be a massive amount of margin calls, and so this is costing the lender a bunch of forward commitment money, costing them money up front that they may lose later, that they can't afford to lose later.
Okay.
So yeah, it's a kind of a dynamic that the consumer doesn't see, but it created a situation where they, out of nervousness, they wanted it to slow down so it didn't implode the banking market in between.
Okay. Now, speaking of dynamics that consumers don't typically see, one of the things we hear about in the news is how low the Fed rate is, right? I think we're at 0 or near 0% right now.
Right.
And I've gotten the question, hey, James, does that mean mortgage rates are 0%? Can you
Yeah.
explain a little bit about that and how that reflects on the mortgage industry?
You bet. I get a lot of the same question. Yeah. So what the Fed does with the prime rate, or what the Fed does with the funds rate, doesn't translate really at all to anything that happens with home loan mortgage interest rates, other than equity lines of credit. Those kind of revolve off the prime rate. But your typical, average 30-year fixed rate mortgage loan on any one of these agency type loans, whatever the Fed does with that rate has nothing to do with what mortgage rates are going to do one way or another.
Okay.
What happens is that they do those things to stimulate, to drive the economy in one direction or another. And what was happening when they dropped it, when the Fed did that recently, they were trying to slow down any kind of a recession because the stock market was kind of in a free fall. And which is also, ironically enough, what caused the mortgage rates to go down. When the stock market tends to get very volatile and people are losing money, they'll pull it out of the stock market and they'll buy mortgage bonds. It's a safe haven. And so the money flows from a terrible stock market into a mortgage bond market. Well, when there's more money in the mortgage bond market available, the interest rates get better, basically. And so that's what kind of drove that. So the Fed doing that didn't do anything to mortgage rates, but it's like a chain effect of a few other things that work that way. I've seen the Fed drop the funds rate in the past, and home loan rates went up. So one thing, they're not exactly connected or tied together that way.
Right. Okay.
Yeah.
That's good to know.
However, I would say, yeah. So I would tell folks just to keep an eye on things, to talk to your lender, to talk to your trusted advisor about what's happening, because you having somebody who's on the street, who's in it every day, is where you're going to get the right kind of advice. Don't go online.
Right.
Start Googling and doing this and that or whatever. All you're going to do is confuse yourself and get a ton of misinformation and things like that. So talk to somebody you trust, and get the real story about what's happening. The other thing that I would expect is that when the Fed dropped the rate like that, the impression was suddenly, oh, great, mortgage rates are going to go to like 0 or 1%. Mm-hmm. The reason that I don't ever really see that happening in the future is that, if you think about it this way, if you were going to lend out a big chunk of money, of your own money, at a 1% or a smaller return like that, it's too little to be worth the risk of lending all that money. So it's quite literally, it's just not worth it. And so there's almost like my opinion is there's almost like a floor kind of at which it really won't, you'll see interest rates go low, but they really won't go to nothing, because there wouldn't be enough return on it to make it even worthwhile.
Right. At the end of the day, it has to make good business sense to the people on the other side too, the people loaning the money.
Sure. Of course. Exactly.
Now, Todd, these are difficult times for everybody. Nobody's been untouched with this whole coronavirus pandemic. And let's say now we're in the beginning of April 2nd, and mortgage payments are going to be coming due. If somebody finds themselves in trouble right now, and they're thinking to themselves, I'm not sure how I'm going to make this payment, my monthly mortgage payment. What advice should we be giving them? What should they do?
Call your servicer. Call your servicer is whoever it is that you're making your loan payments to.
Okay.
Contact your servicer. Ask them what's available. Ask them what they can do. And it's case by case with servicers. There's no blanket policy. There's no, at this time, again, this is it's a fluid situation. So it's kind of still in progress. And so it's case by case, but understand that the slippery slope with that is you have a loan servicer, which is who you make your loan payments to. Ultimately, behind all that, there's an investor that owns that loan. It may not even be the servicer who you're making your payments to. When payments are deferred by a servicer, when someone doesn't have to make their payments, so they get a deferment on that, the servicer still has to make the payments to the investor in the end. Yeah, so that's that's a tough thing for a servicer to allow, because then they're going out on a limb. They're making payments that they may or may not recoup, or however that's going to work out. So that's a tricky thing. But I've heard rumblings about there's going to be some help, because people are going to be in tough situations that are already there. I've had people looking at buying homes at this time who haven't closed escrow yet, asking about deferment on loans going forward. And so my answer to that is, we can't, as a frontline loan originator, we fund and make that loan. We can't make a promise down the road that you don't have to make payments, when the time comes. That being said, when you buy, there is about a month and a half time period between when your payments start. So hopefully this whole coronavirus issue and the things that are driving all these issues, will be starting to mellow out and subside in the next month and a half, Lord willing, right? So even somebody who's, say, buying a home and they're closing in the month of April, their payments aren't going to start until June. So you've got a little bit of breathing room there to sit on for a while before you're going to have any foregoing obligations. And I would just make those judgment calls. Like, it kind of depends. If your job is the type that's relatively secure and you're still going to be at it, I have no problem moving forward with it. If you're nervous about it, then you got to be mindful of your own obligations.
Yeah. Now, Todd, there at Wallick and Volk, anything special you want to share with anybody as far as what are some of the products and things that you offer there? How
we manage during this time, kind of, so to speak. Yeah. So actually, ironically enough, we're on a Zoom call right now. We're not doing any face-to-face, across the desk kind of transactional work right now. However, we are busy doing loans. We have no anticipation of slowing down or closing or shutting down or interruption in service or anything like that at all. We already actually, which kind of complements things during this time, is that we have the capability of pretty much, I can do a transaction start to finish without ever seeing the person face to face. We have an electronic platform that we run a lot of the loan paperwork back and forth, much like kind of your DocuSign type thing is, where you sign documents. We have a loan portal we use. So between the various means of communication, by phone, by email, by text message, by whatever, we're able to pretty seamlessly manage the whole process all the way through right now. And that luckily enough, that was there before coronavirus came. We've already been doing it. So it's kind of business as usual for us. It's just except that we can't really meet up face to face right now. That's all.
Yeah. All right. And so, Todd, if somebody would like to get in touch with you or your team, how would they do so?
Yeah. So you can by phone, by text message, by email. The office number here is 760-336-3911. My cell phone number is 760-960-3524. You can call me, text message me, whatever. FaceTime, it's Apple phone. FaceTime me if you want. I don't care. Or email. It's you can email me at todd.pankratz, PANKRATZ @WVMB.com. Either way, reach out to James. Google me. You can find me. I'm not too hard to find, I don't think. But if you want to find me bad enough, I think you'll find me. So, but yeah, we have no anticipation of slowing down and love to help people, especially during this time. It's a sensitive time right now. So we just really want to reassure people and kind of walk them through things and let everybody know that, we're faithful, that this is all going to pass, and when it does, things are going to kind of settle back into normal, but we just want to kind of plan that way, basically.
Yeah. And we'll get through this together and being mindful and being safe out there. And wow, that was some really great information, Todd. Thank you very much for taking some time and giving me that information and giving that to the public as well. Any questions regarding anything we talked about? Todd just shared with you his contact information. If you have any trouble getting in touch with Todd, contact me and I'll get you his information.
You bet.
And of course, you can contact me also, 760-562-7280 at any time as well. Todd, you stay safe, buddy.
You bet, James. I appreciate the opportunity, and it's always great talking to you.
You too, bud. You too.
All righty.
Talk to you later. Take care, man.
Okay.